Okay, hi there. In this Synoptic revision video, we're going to explore for a few minutes some of the possible micro and macroeconomic effects on the UK economy of a significant slowdown in the Chinese economy. Here's the data for the Chinese economy since 1980. You can see the rapid growth, particularly that period from sort of late 1990s through to the financial crisis in 2008. China growing by 14% in 2007. Since then, the rate of growth has clearly slowed down. Indeed, 6.6% in 2018 is the lowest rate of growth since 1990. Clearly, this is not a recession by the UK standards, but it does mark a clear change in the pace of growth in China. So in the synoptic question, be asked to think about the impact on the UK, in this case, of at a micro level and also at a macro level. So micro is thinking about individual industries, consumers, households, and businesses. Macro, of course, you broaden the entire thing out to the range of macro objectives. So what about the micro impact of a Chinese slowdown? Well, perhaps for UK firms, there's less incentive to outsource to China. One of the reasons for the slowdown, in fact, is that wage costs have been going up. And a lot of manufacturing has been shifting away from China towards countries such as Bangladesh, Vietnam and Indonesia. Slower growth in China could also hit UK exporter profits, particularly for car makers, for example. Another micro impact could be to think about the consequences for the tourist industry in the UK. Tens of thousands of Chinese visitors coming to the UK to visit the attractions and also to shop. Well, what will happen, for example, if that number declines substantially? UK schools and universities might also be affected by a decline in the number of Chinese students coming to the UK to take a degree or an A-level course here. That could have an impact on university finances. Individually, people are often affected by the consequences of a slowdown on global stock markets because many people have money invested in pension funds, and if the global stock market takes a hit, that could indeed affect people's pensions. At an individual level, typically when the Chinese economy grows less quickly, this leads to a fall in a number of key commodity prices around the world. And if commodity prices go down, for example, the world price of oil or gas or copper, then that leads to a fall in prices for many businesses and consumers. If oil prices go down, for example, that should bring down the energy bills for individual families, increase their real incomes, and help to relieve, the hard-pressed budgets of millions of people. What about the macro impact? As I've said many times in these videos, whenever you get a macro impact question, go back to your macroeconomic objectives. Providing you can make those links between China and the UK, you'll be in great shape. So, for example, on inflation, China is a dominant monopoly buyer of many commodities. So a Chinese slowdown is likely to bring down the cost of many commodities, which will reduce cost push inflationary pressure in the UK. UK economic growth is, well, although inflation will be lower, aggregate supply will shift out if commodity prices fall. There's the wider impact on the global economy, which could weaken UK growth. China is now a significant part of the world economy, nearly 20% of world GDP. So if the global economy grows less quickly, that will negatively affect UK exporters in many other different countries. What about the impact on the trade balance? Well, possible contraction in the UK export sales. China is the UK's sixth biggest trading partner. We sell over £400 million worth of goods every week to China, including cars and pharmaceuticals. So if China goes into a slowdown, this could lead to a contraction in export demand, and you could use an ADAS diagram to show that. And then there's the impact on the financial system in the UK at a macro level. So many of the big banks around the world, including HSBC and Barclays, are heavily exposed to China. China has a lot of debt, and if the number of bad debts goes up, this could hit the profits and the stability of banks such as HSBC. Here's the chart showing China's relative importance in the world economy. You can see the share of global GDP adjusted for purchasing power parity rising from 15% in 2012 to around 19% at the moment, and forecast to rise to nearly 22% by 2024. In many ways, China is the engine of growth in the world economy. So if there's a significant slowdown in China, that will have quite big ripple effects on a number of other countries. How can we evaluate the impact? Well, my first point is that China is now the largest economy in the world. So a significant slowdown in China will have an impact on the world economy and therefore knock-on effects on the UK. However, evaluation point, China in relative terms remains a fairly closed economy. So global trade, Chinese trade as a share of GDP is still less than 50%. So the trade effect is likely to be relatively small. Another key evaluation point is that a slowdown is not the same as a full recession. So we're not talking here about Chinese GDP falling, the Chinese economy shrinking. Providing growth stays at, let's say, 4, 5, 6%, then per capita incomes in China will still be going up, and that still provides plenty of opportunity for UK trade and investment. However, the key wider point is if the Chinese slowdown spreads to other economies, for example, Asian economies, including South Korea, Japan, etc., there could be quite a strong negative regional multiplier effect, and that could hit UK exporters just at the time when the UK is looking to pivot some of its trade away from the European Union. My instinct is that the main effect of a Chinese slowdown probably comes through commodity markets, the price of oil and gas, for example, and also asset markets, the global price of shares. And those asset price and commodity price changes, they can filter down to the impact on individual families in the UK. The wider issue I think to be aware of is one of systemic risk. In other words, a major crash in the Chinese financial markets could have a much bigger effect on the world economy. A Chinese slowdown could lead to the spreading of trade tensions and increase in protectionism, for example. I mean, a lot depends on whether the Chinese government is able to use macro policy to achieve a soft landing for an economy where debt is over 300% of GDP. So Chinese slowdown is a macro issue, it's a global issue, but the key in a synoptic exam is to think about some of the micro and the macro consequences.